Good morning, ladies and gentlemen. Welcome to the show. Thank you for tuning in. Uh, anyway, listen, guys. Today it's the 14th, Friday the 14th of January, 2022. Glad to have you guys here. Now, let's get started. I want to talk about, first off, the virus. It's peaking. And we all know what comes next. But in this case, I can see it sinking like a stone sinks in the water when it peaks this time. Different than other times. And we're already seeing that effect. South Africa's seen that effect. And the United Kingdom is starting to see that effect. This particular virus is extremely contagious, and they say that almost everyone's going to be exposed and probably has, or is in the process of. What this creates is like a backfire. Often forest fires, what they'll use to put the fire out, they'll use a backfire. And Omicron is absolutely destroying Delta. It's absolutely, like they say, displacing. But that's another word for destroying Delta. Delta was very dangerous. And I'm, for one, am not sad to see it go. Anyway, so that's what we got going on that front. But we also got another front going on over in Ukraine with Russia. And let's get the chart started right here and take a look at what's going on. It says here that drum beats of war are sounding loud. United States, after Russia declares talks, they're declaring the talks to be a dead end. U.S. says after Russia declares talks a dead end. And so we have to really take this seriously right now. This is not looking good. So let's take a closer look at this. What's Ukraine got? Well, it says here, altogether, the armed forces of Ukraine include 780,000 personnel in their armed forces. Well, this would include not just the soldiers, but this would that would be the total of the amount of personnel that they have. Boy, that's a lot. That's almost 1 million people in their armed forces. That's wild. They got 6,500 tanks. Right here, it says 6,500 tanks. Altogether in their armed forces. That's a lot. It says they have 7,000 combat armored vehicles. That's a lot. I never thought Ukraine was that powerful. 1,500 combat aircraft. That's a lot. And more than 350 ships. That's a lot of ships too. My lands. So they're not really a pushover or a weakling that you'd think that they are, because they're a small country. No, they're not. They're bristling. But let's take a look and see what Russia has. I found one thing interesting here. United States, and we're talking about battle tanks, they only have 6,500. Well, I'm going to tell you what. Ukraine's got 6,500. Sorry. The United States has, what is that? 8,700. So, a few more. They got a few more than Ukraine tanks. Russia's got 22,000. So, yeah. Russia's got a lot of tanks. China's got 9,000. India's got 5,900. So it looks like India actually has, let's go here, 6,500 in Ukraine. They got 6,500 tanks. And India has only, what did it say here? India, 5,976. So India's got less tanks than Ukraine. Who would know? Who would know? But the thing about it is if you're looking at Ukraine as an actual pushover, uh, they're not. Now, I saw a video on here, and I saw the Ukraine army right now is digging in. They're digging foxholes and trenches to fight from. They're actively digging in right now near the border, near the frontier. I guess down in around Donbass or whatever, down in close to the Russian-Ukraine border. They're kind of digging in. The last thing that Russia would want is to move in there and get bogged down. Get bogged down in a they could lose a lot of men and everything. They would want, I'm just saying probably what they would want, is a blitzkrieg to just fly through Ukraine and take Kiev very quickly. That's probably what they want, but there's Ukraine is not a pushover there. They got a lot. I'm surprised, I was looking there this morning. I said, gee whiz, they got a lot of weaponry in Ukraine. Plus, they've received a lot of training in the recent period, they've received a lot of training from armor. Some of that training's come from different countries of the West. Anyway, let's move in there and take a look at the markets today. Now, to switch the subject, we're looking at 22.97 for silver today. It's down. And I'm going to tell you guys, silver and gold are a different animal than cryptocurrencies. We could see cryptocurrencies, if the markets all roll over, we could see cryptocurrencies get busted pretty bad. They really hurt. Gold and silver might move it's just possible they might move in the opposite direction. Because they're a world's premier safe haven asset. If you get enough fear out there in these markets and stuff, you could see actually Bitcoin and gold and silver move in different directions. In other words, what I'm saying is you could see cryptos go down, which would create a tremendous buying opportunity in cryptos. And you could see gold and silver go up in real bad trouble if the markets fall out of bed. You could see. Now, I'm not saying that'll happen. They could go down, too, just as much, This is something that's hard to determine which direction gold and silver will go. I can determine pretty much which way crypto's going to go in a market crash. I think they're going to go down with the markets, with equities and stuff. They're going to go down, cryptos. But the gold and silver is hard to say. They could go up. They might stay the same, or they could fall. It's hard to say just which direction, because they are the premier safe haven asset. And you get an awful lot of fear when the markets fall. And fear, people say, well, I want to hedge against this fear. And what am I going to hedge in? Well, they're going to hedge into the dollar, cash. They're actually going to go for cash. And they're going to go for gold and silver too, some of them. And it could be enough to drive, because these prices that you see here are determined only by paper contracts. In other words, this is a derivatives price you're seeing here. It shouldn't have any reflection on the real gold and silver. Real gold and silver could just disappear. That's probably what's going to happen at a certain point. When the price point hits a certain point, then you're going to see the reaction from the really big money. It's going to move in, and they're going to want physical. Allocation's always been a problem for the big money. But when fear gets great enough, they will solve the allocation problem, and they'll take delivery. And it's over. Game over. When the big money starts to take delivery of this stuff, it's gone. Gold and silver. Silver first. Silver will be gone first. And then the gold will go soon thereafter. And you won't be able to buy any physical. And then you know what's going to happen to the price then? When there's none available to buy? And these paper derivatives contracts at the same time could go to zero. What sets the spot price? In other words, what you could see happen is the spot price go to zero, because what's this paper worth that they're trading if you cannot back it up with metal? it could show the whole thing up. The whole paper derivatives trading thing could all be showing up as just a bunch of papers that has no reflection on the real metals. That could show itself up. I mean, I'm just saying, you know. Anyway, 22.96 for silver. Let's take a look at gold today. These are terrific prices anyway. Down $1.50 on gold, 18.20. Let's take a look now at cryptos and see what they're doing. 20.49 today. Refresh the page, 20.48. So they're not moving basically, and we're looking at a Bitcoin price of 43,036. Now the Dow's taking a little bit of a beating today. It's down 314 points, 326 now. And isn't this exactly performing exactly like I told you guys? Because we're down to the 35,000s now. We're not on the 36s anymore. We're down to the 35s. And what did I tell you guys about this? I said that you're going to see days where you're going to have up days still. But it's not going to be as high. It's not going to go as high as it was. The down day dragged it down, and it's going to come back up a little bit, but it's not. In other words, lower highs or whatever. You know, it's descending. In other words, it's losing steam. The market, and it's going to continue to more or less tread water and lose a little bit of steam. Not a lot. I don't expect it to go down that much, you know, until the next cut. And then the next cut's going to start to go down faster. And then the next cut after that even faster. And then when they start to raise rates, if they can get that far, they'll start to raise rates. They're going to kill this thing for sure. I mean, it's absolutely certain they're just going to keep pounding it until it goes down big time. And when it goes down big time, then they're going to try to prop it back up again. This is the stupidest game in the world. It's stupid. I mean, if they just hold the line where they were, you know, and just let everything go steady, they had a pretty stable economy there. The Fed is creating this instability. You know, and this instability is going to move us quicker toward the hyperinflation ultimately. Because unless they can take the medicine, and the medicine would be an 80-90% drop in the markets, almost everything going bankrupt, a credit freeze, and the entire system starting to crash. That's what the medicine would be. Unless they're prepared to take that medicine, then leave it alone. Because they're just going to have to step back in and repair the damage that they're creating right now. And that's going to take a stimulus that's going to set the system over edge toward hyperinflation even faster on the other side. So, I mean, I can't stand here in front of you guys and say they're not prepared to take the medicine. Maybe they are. Maybe they're going to take the medicine. But if they do, if they fully take the medicine and they don't step in, they let all debt purge from the system, well, you know, get your war paint because you're going to be riding around in a Mad Max vehicle. Pick your name. You want to be called Master Blaster? Whatever. And live in Bartertown? This is where we're going if they fully take the medicine. Because this whole system is all credit. It's all credit. And that means it's all debt. Because the flip side of credit's debt. And if you let all that purge out now, it just flattens everything. I mean, look at how it flattened the system way back in the Great Depression when they let it purge. They let it purge during the Great Depression. What happened? Oh, it was tremendous. Right? But that was back when the system was so much more stable than it is now. And there was back when we were on gold. That's back when we were on gold, and look what it did. What do you think that would do now if they let it purge? Well, unless they're willing to let it completely purge, don't mess with it. Don't create instability like they're doing now, because Honest to God, if you create this instability like they're doing right now, you're just going to make this hyperinflation come faster, because when you have to resolve the mess that you create, you're going to push us over the edge. We're going over the edge of Niagara Falls in a barrel, and we're headed toward this hyperinflation. And, you know, this hyperinflation is going to be a progressive thing. And at the end of the hyperinflation, it's going to squeeze the people to the point where the people cannot take it any longer, and they are going to pull their hair out by the roots and go crazy. That's just the way it is. But that's going to take a while before it gets to that point, hyperinflation. A reset ain't going to save us from that. Because that is well, we've all seen the effects of what hyperinflation does. You know, burnout cars in the street, poverty everywhere, you know, a system in decay, buildings burning down, and just the system doesn't function any longer because the money doesn't function. Just got to take a look at countries like like Zimbabwe, and like oh well, there's a whole list. Look at what it did to Weimar Germany, you know, Venezuela, you know, all these different countries. But that's mild compared to what's coming, because when a hyperinflation's worldwide, you got the craziness worldwide, not isolated to just one country. And I'll tell you the way it goes is the whole system could just basically fall at the end of the hyperinflation. Forget about reset, because the powers that be, I don't see them anyway. Just a mess, and they don't want to go there. They don't want to go there. They want to they're buying time right now. Is what they're really doing. That's what they're doing. They're buying time from the hyperinflation. They're trying to do a Hail Mary pass right now, where they're going to cut the cables on the elevator and let it fall, and they're going to try to stop it from hitting the basement. So they're going to try to stop it at the 10th floor or whatever, a 30-story building. They're cutting the cables in the elevator, and they're going to try to stop it on the 10th floor when it has the momentum that wants to go to the basement. And it's a Hail Mary pass to buy time from this inflation, because they know the results. They know they can't, if this inflation gets completely out of control, there's nothing much they can do, because the only tool they have is printing money. They can't raise interest rates any longer. Not to the area. See, here's an interesting thing about interest rates. I'll tell you guys. When you've got very little inflation, almost none, and you raise interest rates, well, you're going to bring that inflation down. You're going to even cause deflation. But when you've got a lot of inflation that's already underway, like the system that we got right now, you have to get that interest rate up really high. Like in the 1970s, Volcker had to get it up to over 15% before it started to quell inflation. Right now, with the amount of inflation that we got, it probably, with the real numbers of inflation, not counting their phony inflation numbers, with the real numbers of inflation, we'd probably need 20% interest rates to actually stop this train at this point. And these few little interest rates, these low ends that they're doing, is going to make the CPI actually hotter. It has a different effect, because it makes the value of money go up a little bit higher because of the interest rate attached to that money, to said money, you know, and it starts to, and this actually has a different effect than what they're actually looking for. But at the same time, when you're talking about valuations in these overheated markets, it's going to make them go down. So it'll make the price of things, actually, it's going to heat that up. It's going to have a net effect of heating that up. Oh my goodness, 366 points down. We're going to be going along right now in the market with a few good up days and bigger down days, but it's still what I would call a stable market at this point, but it's not going to be stable for much longer. And the same thing applies to cryptos. Gold and silver, heck, they might go up during all this. There's an equal chance, I would say, of them going down or up. So I'm not going to say gold and silver is going to go up right away until this is over. When this is over, I can tell you which way gold and silver is going to go. When they come in and have to rescue the problem that they've created, gold and silver are going to go to the moon. Moonshot when it ends, you know. Let's take a look now at crude oil, 83.08. So it's up today, nearly $1. Crude oil's getting awful expensive, isn't it? And when you think that goes into making everything, that's going to help inflation right there. Everything you buy packaging, the plastic, you'd have to take it out of the plastic, and you know how much plastic's out there now? That plastic's got crude oil in it. Everything you buy has got crude oil in it, you know? It doesn't mean that it's actually, like if you buy produce at the supermarket, you know, and maybe you're buying some tomatoes, the little plastic containers made out of crude oil, and then it took gasoline to get it to the store, or diesel. Okay, let's take a look at the MOVE index today at 72.57, and it's down a little bit. Credit markets seem to be kind of stable right now. Bonds and rates, we're seeing climbing yields today. 1.74 on the 10-year and 2.08 on the 30-year. I told you guys the exact period in time when these bond yields stabilized, or more or less stabilized. Now I expect them to tread water until the next cut. But then they're going to start to climb again. So probably in the next 30 days, we're going to see a U.S. 10-year that's climbing up toward 2%. And a U.S. 30-year probably like 2.5 or whatever, something like that, you know. I mean, that's where they're going. They're going to go up as the Fed pulls out of being a buyer of last resort in this market. Now let's take a look at the DXY, dollar index at 95, and it's climbing today. Thank you guys for listening to my show. Like and subscribe. And catch you guys in the next episode. Bye-bye.